I really wanted today to talk about primarily how we're investing in the trust, and I'll touch on a few key features as well. But the key thing here to start with is we have two investment objectives for our trust. And the first is generating attractive returns over the longer term, and the second is protecting to the downside. And so I wanted to highlight some of the key things that we do as an investor to try and achieve these objectives. Thinking about attractive returns over the very long term, we only invest in very high-quality companies, and we look across the whole world to find them. So we're not restricting ourselves to any particular geography or any particular sector or market, as Ian touched on. It's a greater opportunity set if you look globally, in our opinion. And we invest in a very focused way. So we invest in 15 to 35 stocks. That's the outer bounds of the number of positions we'll have in our trust. And what that really means, it's a bit like a football team. We're trying to pick the 20-odd best players to put on the field at any moment in time. The second thing, talk about downside protection. Downside protection is very important for investing. I'll give you a simple example. If you have $100 and you have a negative 50% return, you're down to $50, you have to make a 100% return just to get back to 100, to get back to where you started. So it's a bit like in investing. For every step you take backwards, you have to take 2 steps forwards to get back to where you were. That's why mistakes really kill you. This is why Warren Buffett says his first rule of investing is never lose money. And his second rule of investing is never forget rule number 1. That's why protecting to the downside and avoiding mistakes is so important. So investing, as I was talking about, investing in high-quality companies, globally, very focused way, that's a part of downside protection. Investing in better businesses gives you a better chance of avoiding businesses that have really significant problems with them. But actually, it's not just about the stocks you pick. It's also, we look at the macro perspective at a high level. It's really what we're doing is we're looking into the world at where the significant risks could be to markets and to our portfolio and trying to minimise our portfolio's exposure to those. And we can take up to 50% cash in our trust as another it's a sort of an option for risk management. It gives us the flexibility to really manage risk. I'm going to come back to all these things and talk about them in more detail. But just before I do, just to mention a few key features of MGG, our specific trust. We have a targeted 4% annual cash distribution. We actually pay it 2% every 6 months. And it's a percentage of the net asset value. So if we do a good job on the investing side, our net asset value grows over time, the distribution will grow in line with that. We also manage the currency exposure in the trust. This is actually, what we're talking about managing the currency exposure. We're talking about managing this exposure to the Australian dollar. Because one of the problems, the issues for an Australian investor investing in global stocks is you're exposed to movements in the Australian dollar. That affects the value of your portfolio. And if the Australian dollar is rising, the value of your international shares is going to be falling. And so we put hedging in, really we're putting hedging in at times when the Australian dollar is at very extreme levels to protect against those movements. And the final thing I want to mention is being a closed-end vehicle that trades on the ASX, which is obviously what we're all here today to talk about, these types of vehicles. We care about the trading experience. We don't want to just raise the money and then off we go. It doesn't matter anymore for us as a fund manager, which some might take that attitude. So we have a buyback in place in our trust. And in the earlier times when the trust first listed, it was trading a bit of a discount at some periods in time. We were actually undertaking that buyback at that time. And if you're buying back $1 worth of investments for 96 cents, that's accretive to unit holders in the trust. And so that's the best thing for us to do. And we publish the net asset value of our trust on an intraday basis. We actually update the intraday net asset value every 20 seconds on the ASX or on our website and other sources through Iris and things. So that's important because it means that when the people are trading our securities, they're fully informed as to the underlying value of what they're trading. So it's a more informed market. Let me just quickly touch on, Ian mentioned this, but just talking about Australian investing, just to put it into context. You see the pie chart on the right there. The Australian market, as a percent of global markets, is only around 2.5% of the total value. It's a very small slither of global markets. This is just the developed markets. If you included all the developing and emerging markets as well, it'd be an even smaller percentage. And if you look at the performance on the left, over the longer term, the ASX has actually done, if you just invested in the ASX, the big indices, the ASX has done very well, actually, compared to global markets. And actually, really, what it is, it's a tale of two halves. Prior to the financial crisis, the Australian market was performing very well. But since the financial crisis, the Australian market has underperformed. And really, why is that? And one of the key reasons for that, actually, is the Australian market is very skewed. If you look at the ASX here on the left, more than 50% of the value of the ASX, or around half the value of the ASX, is in materials, which is resources and financials. And you're really making two concentrated bets in the ASX. You're making a bet on China via resources and you're making a bet on the domestic economy by the financials and really the big banks. That's a big part of the investment. And what you're missing out on the ASX is what the chart on the right shows. This is global markets. Really attractive areas of the investing world, particularly in the consumer space and particularly in technology, we've called here IT. You can't get those exposures in the Australian market, particularly in the technology space. So this is really, I'd say, I'm not saying to everyone you should be investing all your money offshore globally. That's not going to be the right answer for many people. But certainly think about your portfolio and think about whether global investing and the broader opportunity set is something that's going to work for you. I certainly think it's something that is worth asking, worth considering. When I talk about investing in high-quality companies, there's just some examples of what I mean. What we're really talking about when we talk about high-quality companies, we're talking about businesses that have got something special about them, something that gives them a really competitive advantage, and a sustainable competitive advantage, an enduring competitive advantage that's going to last for years, for decades. And some of the examples here, some of these stocks, these companies on this chart are in our portfolio, but some of them aren't. We only invest in things when they're at the right share price, the right valuation as well, not just good businesses. But switching costs is a good example. Think about a company like Apple. Once you own an iPhone, 95% of people who own an iPhone, when it comes time to buy a new phone, they buy another iPhone because they're so hooked in. It's too inconvenient to simplify, but there's so many different reasons why, once you've got one, you stick with it. And that's a switching cost for Apple. What Apple really is, it's a subscription business. People think of it often as a consumer device business, and it's just selling consumer devices, and trends can change. And you think about a Nokia or a BlackBerry going back in time. These types of consumer device businesses only had a very brief moment in the sun when they were really successful. But Apple's actually a subscription business. It's much more enduring. That's a really attractive characteristic. Economies of scale, huge advantage, being the lowest cost producer, really strong brands. That's where customer loyalty, the ability to charge higher prices and make really good margins and really good returns are key things. Network effects are another really consistent aspect of really strong businesses. Visa is actually a very good example. Visa, the largest payments network in the world, it has billions of cardholders on the one side and tens of millions of merchants and banks on the other side. And so if you think about a new competitor to Visa, say I made the Stefan card, no one would take a Stefan card because if you walked into a shop, they'd turn you away. They wouldn't accept it because it's not worth their time. There's no cardholders. And equally, none of the merchants are going to accept the Stefan card because they've got no cardholders. It's the two sides of the equation they've got. That's what a network effect is, and it feeds on itself. And that's a really strong competitive advantage for companies like this. So that's sort of some of the high levels of what we're doing and how we're doing it. But I want to now talk to you about actually what we see in markets today. And I talked about, from downside protection perspective, what we're really focused on. There are two things at a high level that we're really very focused on in our portfolio today. The first is interest rates and the normalisation of monetary policy. And the second is technology change, and particularly business model disruption. Let me just give you a quick little view as to why these are very important. This here is a simplification of what's going on with quantitative easing, what's been going on since the financial crisis. And you've got to look at quantitative easing collectively. So this is the three big central banks, the US Federal Reserve, the ECB in Europe, and the Bank of Japan. They are the ones that have really done quantitative easing in a significant way. A few others have done some small, that's largely irrelevant. And the big three central banks collectively, if you look since the financial crisis, actually the last few years, 2015 to 2017, that was when we had the most quantitative easing. They were increasing the total amount they were spending, increasing the amount of liquidity support they were injecting into markets and driving interest rates down. And in those 3 years, they were averaging $1.5 trillion US per year of liquidity stimulus. It's an enormous amount. Collectively, over the last 10 years, the central bank quantitative easing has been the equivalent as if they had bought 70% of all the government debt that had been issued by the Western world governments. It's an enormous amount, an enormous influence on interest rates and on the supply and demand for long-term securities. And what's happening with quantitative easing is that we're currently in the process of unwinding it. This ECB is ending quantitative easing, and the Fed is already shrinking the balance sheet, actually doing the opposite, what we call quantitative tightening. So you think about the market for long-term securities, the supply and demand curve for long-term securities, this is a huge influence on that, and is driving rates up over the longer term. Then if you think about from the perspective of the Fed in the US, and the interest rate changes are being led by the US, by the actions of the Fed, they're walking a very fine line because they don't want to, they want to do things in a very well-telegraphed, very gradual manner because they don't want to upset markets and they don't want to upset the economy. But the problem is here from the inflation perspective, that's the risk. They're very, very slow and gradual, but if inflation spikes, that could be the risk that pushes them off course. And then we look at the US domestic economy. if I just quickly lay it out, this is the last 50 years. This is the fiscal deficit. So when we're up, that's a fiscal deficit. When we're down below in the middle there, around the 2000s, we actually had a surplus. And then we overlay the unemployment curve on that. And you can see this line, typically, when unemployment is coming down, the deficit's coming down. You don't need to, as a government, you don't need to be stimulating the economy when it's going very well. You add stimulus when unemployment's very high. That's what Keynes said. But the interesting thing here, we just look what's happening very recently. And this is not what Keynes said to do. Because what they're doing in the US right now, with the big tax cuts and the big spending boost, is we're having an increase in fiscal stimulus when unemployment is near record lows. And we've got the lowest unemployment rate we've had in the US for more than 20 years. And yet we're increasing the fiscal deficit spending. That red line there, on the far right, that's where the unemployment line theoretically should be for this level of fiscal stimulus. But actually, unemployment's gone right down. And so from an inflation perspective, this is increasing the risks. And I talk about the Fed. The Fed's trying to walk this very fine line, not wanting to upset things, not wanting to move too fast, but the inflation pressures are building. And the risk we see here is that these inflation pressures, the increased risk of inflation, could provide a shock to markets and a shock to the Fed. And that could mean that monetary policy, the Fed is forced to act much faster than people expect. And that could provide a big shock to markets. And this is really why we're quite cautiously positioned in our portfolio today. I'll come back to our portfolio positioning in a moment, but this is the real primary reason why we're very cautiously positioned in our portfolio today, more defensively positioned in our portfolio than we typically would be, because we see elevated risks around what's happening with monetary policy. Now, I talk about technology change, and this is just a photo of this is actually a Walmart in the US, but it's a self-service, automated checkout in your supermarket. I'm sure you would have all had the joy of using them at your Coles or your Woolworths. And what things here, in about 2009, Walmart in the US, the world's biggest retailer, started to roll these out in a big way across their US store network. And they really increased the number of these. And what happened was, chewing gum sales in the US fell by 15% in volume terms. And it's kind of funny because, self-service checkouts weren't invented to go after the chewing gum business. They were there to put a bit more efficiency into the stores, take out a bit of labour. What they did, though, was they disrupted the business of impulse purchasing. There are other effects that have changed chewing gum. Things like people with their mobile phones, like this a lot, that affects impulse purchasing as well. But self-service checkouts have been a big shift. Now, it's interesting here because the chewing gum market in the US is actually very attractive from an investment perspective. And it's led by Wrigley. They've got more than 50% market share, and it's almost a duopoly. And if you went back to, say, 2000, people were asking Warren Buffett then. This is at the height of the tech boom. And I was saying to him, why don't you invest in technology shares? Why won't you? And he just said, I don't understand them. I don't invest in things I don't understand. And I think that was maybe his excuse because he just didn't want to get into the debate about how overvalued they were. But he did say at the time, but give me a company like Wrigley. That's one of the best businesses in the world. It's very predictable, very steady. It's a staple. People keep buying it no matter what. Very strong brand. All those those characteristics I was talking about earlier about high-quality companies. But yet here's a change, a technology change, and this is not nuclear physics, self-service checkouts. This is not the most high-level, high-tech thing. Fundamentally disrupted one of the best businesses in the world. And this is why technology change and business model disruption is so important. It's actually not obvious, and it's when these changes happen that aren't obvious, that's when investors lose out. So this is why we're very focused on this. A lot of people will talk about technology change and investing, and you'll hear them talk about all the exciting technology companies like your Googles and your Facebooks and your Amazons, and the Chinese internet companies as well, I'm sure. And that gets all the attention. And that's interesting. It's true. We're invested in a number of those companies as well. They are generally very good investments, a number of them. But it's only one side of the coin. Technology change and disruption risk can affect every company in the world. So as an investor, you need to be thinking about this for your entire portfolio. So as I said, we're very defensively positioned today. And the primary thing we're doing in our portfolio to build in that defensiveness is we're sitting at 21% cash today. And then we think about our portfolio actually, broadly speaking, in two halves. On the left, I've got the blue side, and we kind of call them the higher return potential but higher risk investments. And on the right, in the grey shade, what we call businesses that are more defensive, kind of the defensive ballast in our portfolio, lower risk, more predictable businesses. And we kind of split our portfolio roughly half-half between those two categories. Then just go and give you some examples. This is our entire portfolio, by the way. This just shows you where it is. As I mentioned on the technology side, some of these businesses, very attractive, winning businesses. on the left, things like the advertising platforms, e-commerce companies, Apple, the payments companies I talked about with those very strong network effects and the very long runway of multi-decade high growth that they have because of that. As payments move from cash and check to electronic, there's a huge runway of growth for these companies. They're very attractive over the longer term. But it's actually, think about businesses with a low risk of disruption. We had in that right-hand category, in the past, in our global equity strategy, it's been running now for just over 11 years, which is a very similar strategy to our MGG in terms of how it invests and where it invests. We've had big positions in consumer staples in the past. Companies like a Procter & Gamble, like a Unilever, like a Colgate. And these are really strong brands, attractive businesses. But actually, if you look what's changing in the world, some of these, the chewing gum effects, well, you've got advertising is changing. Advertising's moving away from print and television. It's largely moved away from print onto online. And the thing is, companies like a Procter & Gamble, if I take that example, they make things like laundry detergents, washing powders. Their biggest product is Tide laundry detergent in the US. It has 50% market share. 50 cents out of every dollar that Americans spend on laundry detergent, they spend on a Procter & Gamble's Tide product. It's like the Omo of the US. And, but Tide laundry detergent, you can put ads on in the middle of the Super Bowl. The most expensive per second advertising in the world. So the big guys can dominate when it's the world of television advertising. But you can't dominate to anywhere near the same extent on Facebook. They break the audience down to such small little niches. It's much easier for a new competitor to get a foot in the door. Equally then with retailing. The big guys, the big consumer staples companies, they dominate retail shelf space. You walk into your Kohl's, your Woolworths, in the US context, your Walmarts, and they're dominated by these big brands of these big companies. And shelf space is finite. They can dominate in that arena. But you can't dominate shelf space on Amazon. It's effectively unlimited. So again, new competitors have got an ability to get more of a foot in the door. So what I'm talking here about actually is there's a change in the advertising market. There's a change in the retailing market as it moves from physical stores to online. And those changes are having an unintended consequence that they're putting more pressure on these big branded consumer goods companies. And so when we think about defensive investments in our portfolio, we're thinking about those types of risks over the longer term. And we're less attracted to those types of companies as a result. So that's why we're investing in things like restaurants. Starbucks, Yum Brands, that's KFC and Pizza Hut are their big brands. And McDonald's. These are businesses where it doesn't really matter what happens with technology in our view. People are still going to keep going to restaurants. And so they don't face this risk that the rug is going to be pulled from underneath them in terms of structural change that affects their business model. Just before I finish, just to touch on, I think as part of a presentation like this, you kind of have to do it, the returns we've had on our trust. We've had up to the end of August, we've had around a 20% return, which has been marginally ahead of markets. And look, I think the main point I'd like to say here is that that's a 10-month return. The trust first listed in the middle of October last year. It's almost exactly a year from today. And that's too short a time period to judge investment performance. We would say you really want to look at something over a 3 years plus period. So we're delighted that we've had good performance thus far, but we're not crowing about it because it's just too early to judge. Just in terms of how the trust is traded as well, this graph here, I think the font is very, very small, but the orange line is the net asset value, and the blue line is MGG's share price. And so you can see there in the middle there, earlier this year, late last year, the trust was trading a bit of a discount for a period, and that's when we were doing that buyback, and I think that was certainly supportive of the share price, and it was certainly accretive for the unit holders in MGG to be buying back at a discount. But today we're trading roughly in line with net asset value, which we think that's appropriate. That's where these vehicles should all trade, in theory. That's the value of the assets you're buying, and there's a lot of liquidity in MGG, and there's a lot of disclosure. We're making continuous disclosure around the value. We make monthly portfolio disclosures to give portfolio summaries of where we're invested. We disclose our full portfolio every quarter with a 60-day lag. So the market's very informed as to what we're doing. So people should be comfortable buying and selling at the net asset value. So I think that was everything I wanted to talk about. So thank you very much for your time.